Welcome back to Simple Mind Space, your guide to mastering both your money and your mindset. Today, we're diving deep into a pivotal moment in recent history, the 2008 financial crisis. This event continues to reverberate through our lives, shaping everything from our career choices to how we view the future. We're going to break down this complex event in a way that's easy to understand, exploring its causes, its impact, and what we can learn from it to navigate our financial lives today. Think back to 2008. The iPhone was brand new, the world was captivated by the Beijing Olympics, and the global economy was teetering on the brink of collapse. What seemed like a distant problem in the financial sector quickly spiraled into a full-blown crisis that impacted everyone. To understand what happened, we need to rewind a bit further, back to the mid-1990s. The U.S. government, with good intentions, passed laws designed to make home ownership more accessible, particularly for low-income earners. These laws relaxed lending standards, leading to a surge in what are known as subprime mortgages, loans given to borrowers with less than stellar credit. Simultaneously, in 1999, the U.S. government repealed the Glass-Steagall Act, a law established during the Great Depression to prevent excessive risk-taking by banks. This repeal effectively removed the separation between commercial banks, think your everyday bank, and investment banks, the ones playing high-stakes financial games. This potent cocktail, relaxed lending standards and banks free to engage in riskier ventures, created a recipe for disaster. Investment banks, always hungry for higher returns, saw an opportunity in these subprime mortgages. They began bundling these mortgages into complex financial products known as mortgage-backed securities. Think of it like this. Imagine a basket filled with both good apples and rotten ones. The investment banks took these baskets, repackaged them, and sold them as premium, high-quality fruit baskets. The problem was, no one really knew how many rotten apples were in each basket. To further obscure the risk, credit rating agencies, responsible for assessing the safety of these financial products, gave these baskets their highest ratings, essentially giving them a stamp of approval. Fueled by low interest rates and a seemingly endless appetite for these repackaged mortgages, the housing market boomed. Home prices skyrocketed and people felt incredibly wealthy, on paper at least. But beneath the surface, a storm was brewing. By 2006, interest rates began to rise. Remember those subprime mortgages with adjustable rates? Well, those rates reset, and borrowers, many of whom were already stretched thin, found themselves unable to make their payments. Foreclosures soared, and the housing bubble began to deflate. As more borrowers defaulted, the value of those mortgage-backed securities plummeted. The rotten apples were exposed, and the entire financial system began to unravel. Banks, heavily invested in these now toxic assets, faced massive losses. Fear gripped the markets. Lending froze as banks, unsure of who was holding these toxic assets, refused to lend to each other. The financial system, the lifeblood of the global economy, was on the verge of collapse. The crisis reached its peak in September 2008 with the collapse of Lehman Brothers, a venerable investment bank. This event sent shockwaves across the globe, pushing the world into a recession. Governments and central banks scrambled to contain the damage. Trillions of dollars were pumped into the financial system in the form of bailouts and stimulus packages. These measures, while controversial, were deemed necessary to prevent a complete economic meltdown. The 2008 financial crisis had a profound and lasting impact. Millions lost their jobs and homes. Retirement savings were decimated. Trust in financial institutions evaporated. The crisis also exposed the dangers of unchecked greed, lax regulation, and the perils of complex financial engineering. It revealed the interconnectedness of the global economy and how quickly a problem in one area can cascade across borders. The impact of this crisis wasn't limited to just our wallets. It also had a profound impact on our collective psyche. It eroded trust, not just in financial institutions, but in governments and in the very systems that were supposed to protect us. In the aftermath of the crisis, there was a lot of talk about reform. New regulations were put in place, designed to prevent a repeat of 2008. But have we truly learned our lesson? Fast forward to today, and we're seeing some eerie similarities to the conditions that led to the 2008 crisis. Interest rates are rising again after years of being held artificially low. Inflation is rampant, and while the exact triggers may be different, the potential for a financial reckoning is a very real concern. So, what can we learn from all of this, and how can we navigate these uncertain times? Here are some key takeaways. Financial literacy is more critical than ever. We need to understand how the financial system works, how our choices impact our financial well-being, and how to protect ourselves from risks. Don't rely solely on experts. While it's important to seek professional guidance, we must also be our own advocates. Ask questions, do your research, and don't be afraid to challenge the status quo. Diversification is key. Don't put all your eggs in one basket. Explore a range of investment options and consider assets that have historically held their value during times of economic turmoil. Live within your means and avoid excessive debt. Debt can be a useful tool, but too much of it can quickly become a burden, especially during times of economic uncertainty. Prepare for the unexpected. Build an emergency fund that can cover several months of living expenses. This will provide a financial cushion in case of job loss, unexpected medical bills, or other unforeseen events. The 2008 financial crisis was a painful reminder of the fragility of our financial system and the importance of making sound financial decisions. By understanding the lessons of the past, we can better navigate the challenges of the present and build a more secure financial future for ourselves and our families. As we move forward, let's prioritize financial education, make informed choices, and hold our leaders accountable for creating a more stable and equitable financial system. That's it for today's episode of Simple Mind Space. If you found this deep dive into the 2008 financial crisis helpful, be sure to like, subscribe, and share this episode with your friends and family. It's time to take control of our financial well-being together. Until next time, stay informed, stay empowered, and keep those minds sharp.